Good afternoon, everyone, and welcome to Weekly Commentary. Well, after a bumpy ride the previous week, the major indexes recovered last week, ending with gains of roughly 0.7%. Now, this came despite disappointing inflation news. Higher numbers were expected, but the actual results were worse overall. Wednesday, CPI did come in slightly better than expected at 0.5% versus the 0.6% forecast and the 0.6% reading from the previous month. However, year-over-year inflation ran hot at 4.2% compared to 3.8% the month before. Core CPI was likewise hotter than expected. Thursday, the producer prices, PPI, confirmed that trend with wholesale prices rising 1.1% versus the 0.7% anticipated. Markets, including the bond market, largely shrugged off the hotter than expected inflation data. Investors are likely looking past what they believe to be artificially and temporarily elevated inflation resulting from the conflict in Iran, along with the accompanying rise in energy costs. Now, yesterday, the Trump administration announced that an accord had been reached with Iran to end hostilities and reopen the Strait of Hormuz. Iranian officials later confirmed the agreement, and markets and the world today are breathing a sigh of relief. As I write this midday, crude oil prices are down 4% to $74 a barrel. The 10-year Treasury yield has dipped to 4.4%, and the major stock indexes are soaring. This stock rally represents a relief rally, following a significant sell-off sparked by stronger than expected job growths and fears of higher interest rates. Now, hopefully, oil will begin flowing freely sooner than later, and we'll see further price declines in crude prices, which should then reduce energy costs, and inflation should begin to cool as a result. And then hopes for rate cuts may reemerge. All of those hopes are helping fuel today's rally in equities. However, the details of the Iran pact have yet to be released. On the surface, it looks like it could be kind of just another 60-day ceasefire that does include the welcome reopening of the strait without tolls or restrictions. Personally, I'm going to reserve judgment on the quality of this agreement until more details emerge. Likewise, those details are available. Until they're available, it's difficult to assess whether this deal will lead to a permanent or at least long-term end to hostilities and free-flowing oil through the strait, or traffic through the strait. The other big news last week was a record-breaking IPO of SpaceX. That IPO was priced at $135 per share, but first trade opened much higher, and it did climb the share price to nearly $180 before settling the day at around $160, a level many felt should have been the original offering price. Today, the stock is jumping again along with the broader market, and I know many of you are curious about SpaceX and do hope to participate in its future growth. In the short term, however, it's really difficult to handicap the prospects other than to say that at this moment, any investment should be viewed as speculation. Historically, large, highly anticipated IPOs tend to surge early before eventually settling near or even below the IPO price before finding firmer footing for longer-term growth. This week, the big news is the FOMC meeting. Kevin Warsh presides over his first Federal Open Market Committee meeting as Federal Reserve Chairman, and his list of proposed reforms is long. He wants to reduce the balance sheet, something Powell had begun. He also wants to review the Keynesian bias embedded in Fed's economic models, wants to keep the Fed out of fiscal policy, and more. But his first priority, and an important one, is likely to be overhauling the way the Fed communicates. Few innovations since 2008 have been as counterproductive as the adopted forward guidance as a policy tool. Fed officials have come to believe that giving investors advance notice of the central bank's intentions regarding short-term interest rates, they could influence longer-term rates and then, as a result, steer the economy as well. But the constant yammering, the lengthy policy statements, press conferences after every FOMC meeting, nonstop speeches by Fed officials, and above all, the quarterly summary of economic projections and the dot plot have exposed how little the Fed truly understands about the economy. Now, while Ben Bernanke, Powell's predecessor, initiated the post-meeting press conferences, this gabfest went into overdrive under Powell. During Powell's tenure, in addition to his hour-long plus post-meeting press conferences, along with quarterly tarot card reading predictions, Fed officials began delivering a growing number of speeches between meetings. Investors and journalists, for reasons that continue to escape me, scrutinized these orations for clues about the future. This whole process was great for journalists, but really not so good for the Fed, because in the end, it became apparent that Fed officials knew no more about the future than a coin being flipped in the air. In fact, these sages badly overestimated economic growth in 2011 and 2012 when they were predicting roughly 3% growth in December the prior year, when the economy ultimately grew half that, 1.5%. Then they underestimated growth in 2017 and 19, failing to appreciate the impact of the then Trump tax reforms. Their greatest recent mistake, however, was underestimating inflation in 2021 and 2022 by roughly a factor of 3. Now, I've written for years about the destructive futility of public guesses by Fed officials masquerading as informed guidance. I'm very happy that the new chairman appears to see it the same way. Part of my frustration with the Fed's public guidance process is how clearly it exposed the corrosive effect that the media can have on society. That, however, is a discussion for another day. Next week, Friday, is a federal holiday, and the markets, along with our office, will be closed, and therefore my next offering will be a summary of the new chairman's first FOMC meeting. I will be looking for clues about what the new Fed will look like in the years ahead. One thing appears certain: the Fed will hold rates steady this week. So until then, have a great rest of your week.